Good morning to all of you, and thank you very much for joining us today to talk about AVI Global Trust. We plan to briefly review the last year, talk about how the portfolio was positioned, how it performed, and more interestingly, how it's positioned today and where we are seeing opportunities.
There was a man in the building all day, right? No one sort of said that he was funny or I wasn't.
Okay, so just to start with, as a brief reminder, AVI Global Trust, London-listed global investment trust, about £1 billion market cap, with assets of around 1.2, 1.3 billion pounds. The key features of the trust remain the fact that it's very different, an active share of almost 100%. It's very concentrated, with about 20 core holdings today, and the top 10 making up just below 60%. We're trading on a discount of around 9% today. It's been in a relatively tight range over the course of this year. The performance, as you see on the top right corner, it's been a challenging year relative to its MSCI All Country World benchmark, and we're going to talk about that as we go through the presentation. A reminder just the team, we're 13 people on the investment team, 12 of us based in London, one of us based in Tokyo, been working together for many years, and that's a pretty effective setup. Again, as a reminder of some of the key characteristics of AVI Global Trust, we invest in good quality businesses trading at discounts to their net asset value. We've delivered a strong performance track record over many years. And it's not for us, it's never enough simply to buy something trading at a discount. It's about what is likely to happen in order to reverse that discount and to unlock the mispricing or the undervaluation. And a key part of that is being active shareholders in the sense that we engage with management, we engage with boards of the companies we're investing in, and trying to drive through a catalyst for change in a usually constructive way, collaborative way, but also occasionally in a more aggressive way where the situation demands. We are totally benchmark agnostic and unconstrained, and very comfortable with taking high conviction positions in the portfolio where we see good opportunities. As I said at the start, it's been a good year in terms of absolute performance, generating return just shy of 14% relative to the MSCI World Index, which, as you know, has been driven by the strong performance of a relatively small number of large tech companies. We underperformed by about 6%, but more interestingly, relative to an equal weighted benchmark, we did MSCI World equal weighted benchmark, we did relatively quite well as well. For us, it's been a year in which a year almost of two halves. Given the nature of our portfolio, given the relative concentration and the need for catalysts to unlock value, we had a number of catalysts in the first half of the year, which drove very strong absolute and relative performance. The last 6 months have been a little bit less active on the catalyst front. We think there's quite a few interesting situations brewing and developing, which we think will unlock value in coming months. But it's really been a few months of treading water with nothing particularly going bad, but equally nothing exciting having happened over the last 6 months. Back. So when we look at the contributors to the year's performance, you see some pretty sharp and large increases in terms of share price returns. A number of these holdings had been in the portfolio for a number of years and have generated very strong total returns and IRRs over their holding period, notably amongst them KKR and Schibsted and Hypnosis, actually, Apollo and Accordion, the two that are still in the portfolio today. A couple of features just to highlight here: the breadth of these contributors across our universe. So we've got KKR and Apollo, the alternative asset managers. We've got Hypnosis and Cordian investment trusts and Schibsted European holding companies. And that is very much a flavour of the position today in terms of the opportunity set. It's not limited to one particular area. It is very much across a broad spectrum of our universe, which makes it a particularly interesting time. And another just feature of this table, just to highlight, is the fact that we benefited not only from strong NAV performance, which was mirrored by strong share price performance, but also by discounts narrowing. And that's key to our strategy, buying into good quality businesses when they're on wide discounts, benefiting from the double whammy of growth in NAV and also discount contraction, generating superior returns. On the flip side, when we look at the detractors, again, they cover a number of different areas within our universe. ACCA and FEMSA are family-controlled holding companies. Keisei and Toyota are Japanese holdings. Symphony is a listed investment trust. It's got a legacy holding for us. But again, I would point out that whilst we have some detractors, as is normally the case, magnitude of the falls isn't particularly worrying or concerning. But more importantly, when we look at the breakdown of how those returns have been generated, you see that discounts have widened, and that really sets the scene for that to reverse and to drive performance in the future. It would be far more worrying to us to see very sharp declines in the values of these businesses, as well as narrowing the discounts, which would pose a problem to us going forward. When we look at the portfolio changes to highlight over the course of the last 12 months, on the decrease side, you'll note that there's a good handful here of situations that we fully exited. We've highlighted Schibsted, Hypnosis, and KKR in an earlier slide, very successful investments. Pantheon and Brookfield and Pershing Square, also successful investments where we fully exited those positions. And the story really from here is building up concentration and conviction in newer situations where we see very compelling opportunities. On the increase side, we've got big increases in D'Ieteren, News Corp, and indeed Chrysalis, SoftBank, Cordian. We've got slides coming up on most of these names.
No one's been actually understanding what it is they've been doing or not doing. So when it's been reviewed.
So we're happy to talk about each of those names as we get to them in the presentation. A reminder that our returns are likely to be lumpy. They are driven by those idiosyncratic events that emerge over time, regularly over time, but not necessarily consistently. We've seen the benefit of that throughout the course of this year, in the first part of the year, and as I said earlier, we expect to see more of them as we go through the next year. Gearing, just to highlight in terms of our approach to gearing, many of you will have heard us say on previous occasions that we're not fans of trying to time markets. And generally speaking, if we find good, interesting opportunities, and particularly when we find good opportunities across the board, across the breadth of our universe, we prefer to be fully invested and focus on the fundamentals of those situations and the long-term return potential. Gearing does get modified from time to time. You note that during the course of 2022, as we started to see a correction, particularly out of growth names on valuation concerns, we were more concerned about valuations generally. We were seeing a number of companies in our universe trading at premiums to NAV and held a little bit of cash for a short period of time. But as we became more excited about the opportunity set, the gearing's been in the high single-digit range fairly consistently over the last couple of years. Today it stands around 7 or 8%, which again reflects a high degree of conviction and excitement about the opportunity set that we're seeing. As I said, we are benchmark agnostic. We know what is in the benchmark in terms of geographic allocation, but we don't spend a lot of time thinking about our allocation relative to that. We've long-term held a lower allocation in North America when compared to the benchmark. Remarkably, the US exposure in the benchmark is now approaching 70%. But from our perspective, we have been finding more opportunities in the US. It's now around 25% exposure, which has been increasing gradually over the last few years. You'll be aware that we are very optimistic and bullish about the opportunity set in Japan, have been for the last 5 years and continue to be so. And that's a large relative overweight. And Europe continues to throw up a good number of opportunities, noting, of course, family holding companies, which are a key feature of our European exposure. So we list here all our holdings. You'll see the names as well as the discounts. As I said earlier, we've got slides on half a dozen or so names, which Tom and myself plan to go through. If there are any names on this list here that you'd like us to expand upon or have any particular questions on during the Q&A session, we're very happy to come back to them and talk about. So I'll hand over to Tom to talk about this.
So this is a really good example, I think, to talk through for a couple of reasons. One, it was a very large contributor to returns over FY24. But it also gives a very good insight, I think, into one, the way we approach engagement with companies, particularly investment trusts, and two, how when these events do play out successfully, they can give very meaningful increases to AGT's NAV. So for those of you who don't know, there probably aren't many on this call who don't, the fund came to market in 2018 to invest in music rights. Like a lot of alternative income plays at the time, it traded at a premium for the first few years. And then as rates rose, again, like a lot of alternative income peers, the shares sold off, went to a very large discount to NAV. And that initial move was very much about broad market moves, macro, interest rates, and so on. But there's been a further leg down in the share price on the back of concerns around particular company issues around governance, accounting, DD by the manager on deals that they've done. Now, I could spend almost the entire hour going through the various events that then unfolded, but I think the key summary is that we took a very large stake in Q4 23 ahead of a vote on continuation for the company. We led a public campaign to remove the chairman and other directors, and we successfully won that vote. We helped bring on 2 new guys onto the board, and the outcome was a very successful one for shareholders. The company was then sold to Blackstone for a very large premium to the undisturbed price prior to the engagement. I think if we zoom out slightly here, I think there are some key broader lessons here. I think one, the importance of doing extensive research. So we spoke with lots of industry experts, people who actually sold catalogues to the manager. And that work we've done really gave us the conviction to add to our holding very materially at times when the share price seemed to be falling day upon day. I think it also shows the value that activism and engagement can add as well. And I think finally, the importance of good boards. I mean, we saw this on both sides of the equation. We saw what I would say was a very weak board that failed to oversee the manager properly for a number of years. And then the new directors coming in did a fantastic job. They held the manager's feet to the fire and negotiated a very good outcome for shareholders in the end.
Schibsted is a very good illustration of our approach to investing in family-controlled holding companies, what we're looking for, where and why inefficiencies arise and how we seek to exploit them, and then how they generate very strong idiosyncratic returns for us. So Schibsted is a Norwegian holding company. Its business is online classifieds, both in the Nordic region and more broadly across Europe. Structurally, it held a stake in Adevinta, a listed company focused on online classifieds, and then alongside that, it had an unlisted online classifieds business. When we bought into it a little over 2 years ago, a stake in Adevinta that it owned accounted for a large proportion, over 70% of its market cap, which meant that the market was heavily undervaluing the unlisted asset. With holding companies, we can't do what we did in the case of Hypnosis. We can't be the largest shareholder. We can't force through change when shareholders who are in control don't want to change. So we have to look for different things. We look at the quality of the business, the potential for it to grow in value, but also the alignment of interest with management and other shareholders. Are they going to be doing good things for us minority shareholders? And in the case of Schibsted, what led to this being a very high conviction investment for us was the fact that management publicly were frustrated by the undervaluation. They initiated a strategic review to analyze why the undervaluation existed and to explore options in order to remedy that. And that really provides the basis for the high conviction investment, and ultimately led to Adevinta, the listed company, being sold to private equity at a very attractive valuation, a big premium to where it was when we first invested, and then using a lot of that cash that came in to the company post the sale of Adevinta to return capital to shareholders, and finally leaving Schibsted in a much more simplified structure, much more readily understood by the broader market, rather than being a clunky, complex structure with a big listed stake alongside an unlisted business. And that really is the pathway that we seek to replicate across the board when we invest in holding companies. And when we talk about a couple more examples going forward, you'll see that repeated. So D'Ieteren is a case in point. It's the largest position within the portfolio currently, and one which we've been aggressively adding to over the last couple of months. D'Ieteren is a Belgian holding company run by its 7th generation. The key asset and the jewel in the crown here is the stake that they own in Belron. For those of a certain age, you'll recall in the UK an advertising program back in the day for a business called Autoglass Repair, which repaired windscreens for cars. That is Belron's business in the UK, and they are a global business. The interesting thing about repairing autoglass or car windscreens is that it has become a very high margin business today. As windscreens have become more complex with sensors and cameras throughout those windscreens, when you need to change it, it is a much more costly and much more profitable venture for Belron. So D'Ieteren sold a minority stake in Belron 6 or 7 years ago to private equity. Since then, it's continued to grow in value. The value is not that well appreciated by the market, as we see it trading on a 35 to 40% discount relatively consistently. There was some excitement or anticipation that Belron would be IPO'd, and that was one of the reasons why we held quite a large stake. But in the end, a couple of months ago, the family announced some changes to their shareholding structure. One branch of the family who is involved in the running of the business decided to buy out the other more passive branch. And in order to fund that purchase, they recapitalized Belron with some debt. They're paying out a massive dividend. The dividend, which will be paid out, is around 74 euros a share, due to be paid in the middle of December. And that compares to a share price today of just under 200 euros a share. So a massive dividend. The family will retain control of the business. We think Belron will continue to grow, and it's a very attractive business. And in the meantime, the share price has been weak on the announcement, we suspect fueled by Belgian retail investors not being happy about having to pay 30% tax on the dividend they're going to receive. We pay a tax rate of 10% on this, and post the dividend, we think we'll be owning a quality business at around below 10 times earnings, when its appropriate valuation is probably around twice that.
So News Corp is our second largest holding in AGT, and it really ticks the three boxes we look for in terms of high quality assets that we like, a deep discount to NAV, and what we see as a corporate event on the horizon that will unlock or perhaps completely eliminate that very wide discount to NAV. The two main assets are REA Group. REA Group is the Australian version of Rightmove, and also made a bid for Rightmove in the last month or so. So essentially, REA Group is the #1 player in Australia in a winner-takes-all market. Very powerful network effects, very high margins, and very consistent top and bottom line growth. The business probably isn't optically cheap on near-term multiples, but high-quality businesses like this very rarely are. REA Group is listed. It's the only listed holding within the News Corp sum of the parts. The jewel in the crown, we think, really is Dow Jones, which is a private business. Dow Jones, pretty best known for owning the Wall Street Journal, which they very successfully monetized via a subscription paywall service there. But it also owns an information services business, which provides essentially pricing benchmarks for derivative trades. And that's really a subscription database offering, again, very high recurring revenues, very high margins. So two assets there that comprise the bulk of NAV that we think are high quality, attractive assets. The shares trade due to this conglomerate holdco structure at a near 50% discount to NAV. So what's going to change that? We think that there's been very clear indications from management on earnings calls that the market has failed to react to, that they're looking very seriously about a radical change in the group structure. We can see on the left-hand side towards the bottom a quote from the CEO on a conference call earlier this year, where he refers to a revolution in the group structure. Now, what does that look like? The blue sky scenario we think would be a spin-off of the listed stake in REA Group. That would clearly unlock a huge amount of value. But there's also a possibility, and perhaps in conjunction with an IPO and spin of the Dow Jones business. So again, we have those three things we look for. And I think it's really a sign of the market we're in, for whatever reason, that a company can be that explicit about the prospect of a radical restructuring, and the shares still trade at this very deep, very compelling to us discount to NAV.
Another holding we've been adding to is Bolloré Group. The group structure that you see here on the chart is reminiscent of what we typically used to see across the European family holding company space 20, 30 years ago. It's a very complex self-ownership loop designed really to allow the family to control a greater pool of assets with limited amount of capital. The story of Bolloré is that Mr. Bolloré turned 70 in the last year and spent the last 40 years having acquired his family business back from the banks for £1 40 years ago, rebuilding his group and cementing his control. A couple of interesting features just to note here. There are essentially three assets within Bolloré today. The first is a large proportion of cash, and that came from the sale of legacy businesses across Africa, logistics and transportation businesses primarily. That leaves them with 6 billion euros, which is very important because that cash can be used, has been used in the past for share buybacks, which are very accretive when you're buying on very wide discounts, and also allow the Bolloré family to increase their influence and control of the group without having actually to put their hands in their pockets. The other two assets are a stake in UMG, which is Universal Music Group. We think is a fantastic business, high quality business. And alongside that is a stake in Vivendi. Bolloré owns 29% of Vivendi. And as some of you will be aware, Vivendi is going through a restructuring. Currently, that will see it in the next year split into 4 separate companies, and that is explicitly being designed to address the discount to some of the parts that Vivendi trades at. So that creates an interesting catalyst for Vivendi to re-rate, but also having separated the four components into 4 separate parts will make it a possibility that Bolloré will seek to ultimately at some stage buy the entirety or seek to increase its control over one or more of those assets without having to actually take control of the broader Vivendi group. So there's lots of things happening within the group. The fact that they've now got cash makes all that more likely. As in the case of News Corp, we don't know when all these things are happening, but we can see quite clearly that there are maneuverings going on that should lead to ultimately a re-rating in Bolloré. And as you see from the table here at the bottom, the share price of €6 is pretty much covered by the stake in UMG. There's more cash in there. So a lot of value here that investors are leaving on the table.
On to Reckitt, which is a company we bought into the portfolio in calendar year 24. So we're actually able to acquire Reckitt, which we think is a very high quality business, at just a 13 times P multiple, due to what we deem to be the overreaction to a legal case over in the US around the baby milk part of the nutrition segment of the business. It's our view that the liability implied by the market far exceeds both our base case and the maximum possible liability, given that business segment is actually ring-fenced from the rest of Reckitt. So if we look at Reckitt today, it's a company that many of you will have heard of, been a large UK listed company, but we really look at it through a sum of the parts lens, which may differ to other market participants. So we separate it into the health segment, which includes things like Gaviscon, Nurofen, Strepsils, etc. And then the hygiene segment, which includes well-known brands like Finish, Dettol, and so on. So the business today has obviously been, or rather the share price rather, has been heavily weighed on by the uncertainty around the legal settlement. We expect that to be resolved one way or the other sometime in the second half of 2025. And what's important, or more important, we think in the long term, is the management's actions where recently they decided to spin off a lot of non-core brands and refocus on what they call their power brands for the most part. So what we see today is a company that once they've sold off those non-core brands, if we use the rumoured price that PE are willing to pay for the company, that puts overall Reckitt on around a 12 times EV/EBIT multiple, which compares to peers that trade around 18 to 19 or so. So list of PE, we have a few holdings in this sector. We have Oakley Capital, very long-standing position. More recently, in the last couple of years, what was Princess Group, which is now Partners Group Private Equity, and a stake in Harbourvest as well. I think the key question that's been facing the sector over the last 2 years, really, since discounts exploded, is how credible are the NAVs? We think they are credible for the most part. I think there's a few reasons behind that. One, it's not satisfying from a purist perspective, but the fact is that PE marks tend to lag the market on the way up, and they lag the market on the way down as well. So on that down leg that we've had, they've basically been taking advantage of a buffer that are being built up by not writing up their holdings to market levels in 2019, 2020, 2021, and so on. Secondly, we continue to see uplifts to carrying values upon exits. Some funds more active than others, and obviously activity in general has dried up slightly over the last couple of years. But when exits happen, they are still coming at very large, chunky premium to where they're last carried. But I think most importantly, particularly for the diversified fund of funds, is that there's a very active private secondary market for stakes in PE interests. If you're a pension fund or an endowment or a foundation, and you think you're over allocated to PE, you can access this market now. And from speaking with our sources, various private brokers, the average discount for a buyout fund today is between 5 and 10%. That compares to discounts on the fund of funds of between 30 to 45% today. There's a very clear arbitrage there that the funds could, and we would say should, be taken advantage of in terms of using secondary sale proceeds to acquire their shares at much wider discounts to NAV in the public market. Now, Chrysalis is up quite strongly today on news that Klarna has finally filed for a listing. But to backtrack slightly, I think Chrysalis gives a great example of the tendency of markets to overshoot in both directions. We saw it when Chrysalis launched in 2018. It's a late stage growth equity business. That was obviously very in vogue in 2018 when they launched, and the shares swiftly went to a premium that they sustained for a long period of time. Things got very excessive in 2021, the likes of SoftBank and Tiger throwing money around at late stage companies, and the shares peaked out at 250 pence per share, or rather the NAV peaked out at that level. The share price was actually higher than that. We then acquired a stake following the market sell-off, inspired by the rates increase over 2022. And we were buying shares initially at a 50% discount to an NAV that had been marked down by more than 40% over that time. So again, it ticks those three boxes we look for: a wide discount to what we think is a credible NAV. You've got a catalyst in the form of a buyback that's been triggered, which will see the company devote £100 million to share buybacks. That equates to around 20% of market cap at the time the policy came into effect about a month ago. The key question in a company like this, as with listed PE, but potentially more so, is how credible are the carrying valuations for Chrysalis? So I guess the starting point is that the market cap today is covered by simply the carrying values for Starling, Klarna, and by cash, and implicitly assigning no value to the rest of the holdings. Quite a large margin of safety there. Secondly, we've seen Chrysalis exit investments at premium to carrying value, most recently Graphcorp and Featurespace at between 20 and 30% exit uplifts there. And then finally, we come to the actual holdings themselves. So taking Klarna first of all, it's carried at just below $15 billion in the reported value. The upper end of the IPO range is around $20 billion. So upside of those figures do actually play out. There's also a very active secondary market in Klarna as well, where private interests change hands. And we've discovered that trading price valuation there is around $13 to $14 billion. So a little bit lower than where it's been carried in the reported NAV for Chrysalis, but does certainly provide a floor under the valuation. Then finally, there's a listed peer called Affirm in the US. If we apply Affirm's multiples to Klarna, we get to a $22 billion valuation. So a lot of support there for the carrying values, the same for Starling as well. And we think the shares, despite the rise today, are still very much undervalued where they are.
I'm conscious that we want to leave some time for some questions, so I'll briefly address the opportunity in Japan by saying that it continues to be a fantastic opportunity. And in fact, when one contrasts the situation today with the situation that we saw 6 or 7 years ago, it's even more compelling, I would say. Back then, there was a lot of regulation, a lot of reform on the agenda to address undervaluations. And we've demonstrated over the last 6 or 7 years how we can add value in that process. But today, companies are much more open and willing to change, to address their undervaluation. We're no longer pushing against a closed door, but we're pushing on an open door when it comes to engaging with companies. Management increasingly want to see a higher share price and want to hear our suggestions as to what they can do. And on top of that, Japan is developing into a much more active market when it comes to change of corporate control. We're seeing a lot of activity from private private equity investors. And so it's very much a situation or a market where we find lots of compelling opportunities, but equally we find lots of likely catalysts to unlock value. So in summary, I would end by saying that when one looks around the world, there's a lot of noise, there's a lot of challenges on the horizon. But equally, when we look at our opportunity set and we look at our portfolio and our universe, we see a lot of inefficiencies, we see a lot of opportunities, and more encouragingly, we also see a lot of potential catalysts. Catalysts that in some cases we as shareholder activists are driving, and in other situations, catalysts which our aligned investors, such as family-controlled situations, are themselves working to unlock value for all shareholders. So taken in aggregate, it's a very exciting opportunity set for us. As I said at the start, it's been a fairly quiet 6 or 7 months, but I have no doubt that there will be a lot of activity within our portfolio over the coming 12 months. And with a starting point of holding our good quality assets on a 36% discount, the prospective returns, I would argue, are particularly attractive. So thank you very much for listening to us thus far.